For more on this, we're joined by Ahmed Assiri, who's a research strategist at Pepperstone. Welcome back to the programme, Ahmed. Now, indices in Tokyo and Seoul are scaling new highs, while Hong Kong seems to remain under pressure. What's driving the divergence here, and is it likely to persist?
Thank you for having me in the show. Indeed, the sentiment in Asian markets appears to diverge, where Japan and South Korea benefit from this rally, and as those two economies were heavily dependent on the oil and energy product coming from the Middle East. Whereas in Hong Kong, we see a level of weakness and extended the previous sentiment, and it is correlated to the US equity markets. As we see now, Hong Kong index is selling off nearly 2%. Also this week shows data from the retail sentiment and sales in Hong Kong, and it shows the weakest growth, or in fact negative growth, and we haven't seen that in nearly 3 years. But the overall story, it's more about the macroeconomic factors, and we see Japan is having really happy days, 40% gain in the index from the beginning of the year, and it is more about the growth overall.
And we're seeing tech-heavy markets like South Korea, Japan and Taiwan continue to outperform. Is the AI trade still the dominant driver?
Indeed, semiconductors from Taiwan to Korea is still the main driver for this rally, and we have seen that actually over the past few months, and it is extended to the rally. In fact, began back in 2023. So it is a global trade, and it is building out the AI infrastructure, and it seems to be still accelerating rather than stabilizing. So this definitely gives the headwind for those economies to even rally further, although the profit taken now is a factor, and we see a bit of rotation from those really heavily concentrated around this trade to the broader sectors for diversification and anticipation for any sharp profit taking.
Meanwhile, oil is extending declines despite maritime traffic remaining below pre-war levels. What's the market pricing in about supply conditions?
I think the market is actually pricing optimism, and luckily this time is actually backed by a positive signs from logistical or ships action passing the Strait of Hormuz. We see data today actually showing ships passing the Strait of Hormuz, whether that for Saudi Arabia or Qatar, and we haven't seen this over the past few times. There was a deal in the making. So this is a positive news for energy markets, although it's still nowhere near what we were late in February, but it is definitely positive news. And we see the market is pricing well below now 80% per barrel. And we see also the future deliveries actually taking this Iran war premium. So overall, that's a positive for the energy market and for the consumers, especially in Asia.
Ahmed Assiri in Melbourne, great to have your analysis. Thank you.